What if I told you that the thing most people are completely terrified of, debt, is actually one of the most powerful wealth-building tools ever invented? And I do not mean credit card debt. I do not mean buying a boat you cannot afford. I mean the exact strategy that billionaires, real estate moguls, and savvy investors have been quietly using for decades, while the rest of us were told, stay out of debt, save your money, play it safe. That advice sounds responsible, but according to Robert Kiyosaki, the man behind one of the best-selling personal finance books of all time, Rich Dad, Poor Dad, that advice is exactly what keeps most people broke. Today, we are breaking down how the rich use debt differently, not to go broke, but to get richer. Stick around, because this one might genuinely change how you think about money. So, let us start with the foundation. Robert Kiyosaki grew up with two father figures. His biological dad, his poor dad, was brilliant, highly educated. He had a PhD. He worked for the government, had a steady paycheck, and spent his whole life telling Robert, go to school, get good grades, get a safe, secure job, stay out of debt. His rich dad, his best friend's father, had a completely different philosophy. He didn't even finish 8th grade, but he built businesses, owned real estate, and eventually became one of the wealthiest men in Hawaii. And here's the thing. Rich Dad had a lot of debt, millions of dollars in debt. But he wasn't drowning, he was thriving. Why? Because the rich don't just look at debt as debt. They ask a fundamentally different question than the rest of us. Poor Dad asked, can I afford this? Rich Dad asked, will this make me money? That one shift in thinking, that's where everything starts. So, here's where Kiyosaki drops one of the most important concepts in the entire book. And honestly, one of the most important financial concepts you will ever hear. Assets versus liabilities. And his definitions might surprise you. An asset, in Rich Dad's world, is anything that puts money in your pocket. A liability is anything that takes money out of your pocket. Simple enough, right? Here's where it gets wild. Most people think their house is an asset. Kiyosaki says, in most cases, it's actually a liability. Why? Because it's not generating income. You're paying a mortgage. Property taxes, maintenance, insurance. Money is leaving your pocket every single month. But if you buy a rental property, that's an asset. Tenants pay rent, money comes in. The property potentially appreciates in value. That's an asset. Now apply that thinking to debt. Bad debt is debt used to buy liabilities. A car you can't afford, a vacation on a credit card, consumer purchases that don't generate income. The debt costs you money, and what you bought with it also costs you money. Double hit. Good debt, what Kiyosaki calls leverage, is debt used to acquire assets that generate income greater than the cost of the debt. Let me make that concrete. Say you find a rental property for $200,000. You put 20% down, that's $40,000 of your own money. The bank loans you the remaining $160,000. Your monthly mortgage payment? Let's say $900 a month. You rent the property out for $1,500 a month. After covering your mortgage, property management, taxes, and maintenance, let's say you're netting $300 a month in cash flow. Now here's the beautiful part. You didn't need $200,000. You only used $40,000 of your own money, and the tenants, not you, are paying down that mortgage every single month. The bank's money built you an asset, the tenant's rent pays the bank back, and you pocket the difference. That's good debt. The debt is doing work for you. This is why Kiyosaki writes in Rich Dad, Poor Dad, the rich use debt as leverage to build their wealth. The poor and middle class use debt as a lifeline to maintain their lifestyle. One type of debt builds you up, the other slowly buries you. And here's what's wild. Both people might have the same amount of debt on paper, but one is getting richer and one is getting poorer. The debt is not the difference. The purpose of the debt is the difference. Now, let us go a level deeper, because this is where it gets really interesting. Kiyosaki talks a lot about something called OPM, other people's money. The rich do not just use debt to build wealth. They use other people's debt, Other people's capital, other people's time. They understand leverage at a fundamental level. Think about how any major real estate developer operates. They rarely use their own money. They pitch investors, secure loans, use the bank's capital to develop massive projects, and then pocket the returns while paying back the debt over time. Or think about corporate America. Companies borrow money at low interest rates to invest in equipment, expansion, or even buy back their own stock, which drives up the share price. The shareholders win, the executives win, the lenders get their interest. Nobody at the top of the financial food chain is sitting on a pile of cash. They are sitting on a pile of leveraged assets. Warren Buffett runs Berkshire Hathaway, which owns insurance companies. Know what insurance companies do? They collect premiums up front before paying out claims. That pool of money, called the float, is essentially free debt, and Buffett invests that float to generate billions. He's been using other people's money for decades. That is not luck. That is strategy. So if good debt is so powerful, why doesn't everyone use it? A few reasons. First, financial education. Kiyosaki is pretty blunt about this in the book. He says the school system teaches you to be an employee. Study hard, get a job, get a paycheck. Nobody teaches you how money actually works, how investing works, how leverage works, how taxes work. That is not an accident. A population of financially literate people is harder to exploit. Second, fear. Debt is scary. And look, I get it. When most people think of debt, they think of credit card interest eating them alive, or that feeling of dread when the bills come in. Those are real experiences, and they condition us to avoid all debt. But Kiyosaki's point isn't get into all the debt you can. His point is understand what the debt is for. Is it buying you an asset, or is it buying you a liability wrapped in the feeling of happiness? Third, lifestyle inflation. This is the killer. As people earn more money, they tend to spend more. Bigger house, nicer car, better vacations. And a lot of that gets financed with debt, but none of it produces income. It all drains it. In the book, Kiyosaki calls this the rat race, and it's not just for broke people. There are people making $300,000 a year who are completely broke because their lifestyle expanded to eat every dollar they earned, plus some they borrowed. The rich stay out of that trap by making sure their money and their debt is always working. Okay, so we've been talking a lot of theory. Let me bring this home for you. You do not have to be a billionaire to start thinking this way. Here's what actually applying these principles looks like at a real-world level. Step 1. Know the difference between your assets and liabilities. Write it out. Everything you own. Does it put money in your pocket, or does it take money out? Most people have never done this exercise. Most people would be shocked by the answer. Step 2. Before taking on any debt, ask yourself Kiyosaki's question. Will this generate income greater than the cost of borrowing? If yes, it might be worth exploring. If no, think twice. Step 3. Start small. You don't have to go buy a 20-unit apartment complex next Tuesday. Could be a single rental property. Could be a small business loan to start a side hustle. Could be using a low-interest credit card to fund an investment and paying it off in full when the return comes in. Start understanding leverage before you need it at scale. Step 4. Invest in your financial education. Kiyosaki literally built a brand around this. Rich Dad, Poor Dad is the starting point, but also dig into real estate investing, tax strategy, and understanding how businesses are valued. The more you know, the less you fear, and the less you fear, the better decisions you make. Look, the rich are not smarter than you, they're not more hardworking than you, but they do think about money differently. They've been trained, or they trained themselves, to see debt as a tool, not a trap. And that distinction, that's worth millions. So let me ask you this. The next time you're thinking about your finances, your mortgage, your car payment, any debt you have, ask yourself Rich Dad's question. Is this making me money, or is this costing me money? That question alone, if you make it a habit, could change your entire financial trajectory. If this video opened your eyes even a little, do me a solid. Hit that like button, subscribe if you haven't already, and drop a comment below. Tell me, what is one thing you have always believed about debt that you're now rethinking? I read every single one. And if you want to go deeper on concepts from Rich Dad, Poor Dad, assets, the cash flow quadrant, why taxes favor investors over employees, I'm going to link the next video right here. Trust me, you do not want to miss it. See you in the next one.